Welcome back to another video. Sohail here, and today I'm going to teach you 3 price action strategies that help you predict potential movement of the market that have high probability. They are purely based on price action. No indicator is used except volume, which is used for some confirmations, and it's basically part of price action analysis, as you know. Alright, the first price action strategy that I want to teach you is called inside candle strategy. In this pattern, first we have a candle that touches a support or resistance level, and it's better to be a long candle, and after that we have some candles that are totally included in the low to high range of this candle. This formation shows us that the price is in a very tight consolidation period, and it tells us that the price is refusing to go back, and this gives the possibility that the price is going to break the support level. We have the same setup for resistance levels but in the opposite direction. After this pattern, you can see that this long red candle broke this support level with considerable increase in the volume, as you can see, which actually confirms that this was a valid breakout. Please pay attention that the same pattern can also happen after breakouts in a form of a pullback or retest of the broken level. For example, on this chart you can see that this long green candle broke this resistance level, and after that we got 4 candles above the resistance level, which is now acting as a support level, and these 4 candles are in the low to high range of the breaking candle with a tendency of moving upward. This shows a pause and consolidation before further continuation of advancing after this breakout. The second strategy is called gap and long wick strategy. In this strategy we have a gap, and ideally it's better to be a large gap. The larger the gap, the stronger will be the pattern. The strategy is used on short time frames like 1 minute or 5 minutes, and it's used on stock market where sometimes we can see gaps at the opening hours of the market, or in Forex market at the beginning of the week. During the day also the gaps can happen, but the kind of large gap that we want for this strategy usually happens at the opening hours of the market, where because of the overnight news and fundamental factors we suddenly see a considerable jump or fall at the opening hours of the next day. So this is a perfect strategy for making some quick profit at the opening hours of the market. As you can see on this chart here, we have a gap, considerably large gap, and after that we have a hammer candlestick, which is naturally a bullish candle. When we have a gap on the chart, the gap acts as a support or resistance level. In this case that we have an upside gap, this gap is acting as a support level, and until it's not filled by the price it remains active as a support zone, which means that after formation of this gap the price will have difficulty to come back to this area. And now after this gap we have hammer, which is a bullish candle. This long shadow of this candle tells us that the price couldn't fill the gap, and these lower prices are rejected by market participants, and this shows that buyers are in control, so more advancing of the price is expected after this candle. When we have this set up an upside gap and then the candle is closed like this, which indicates even more rejection of these prices, this pattern gives the possibility that the price is going to continue its advancing. In another example here you can see that we have downside gap, and the gap is considerably large. The price tried to go up and fill the gap but no success, and even these prices are rejected by market participants, and you can see that the result is an inverted cross doji, which is naturally a bearish candle, and having this bearish candle in this situation below this gap, which is acting as a resistance level here, gives the possibility that the price is going to continue its declining. Please pay attention that inside candles pattern that I explained earlier can also appear here in gap and long wick pattern, and this gives even more probability to the continuation of the movement. For example, on this chart you can see that we have a long wick candle after this gap, which is actually a bullish candle, and after that you can see that we got many inside candles that are in the low to high range of this long wick candle. This shows that the price is in a very tight consolidation here and it refuses to go down and fill the gap. This combination of long wick candle after the gap with these inside candles gives us a very strong probability that the price is going to break out of this consolidation period and continue advancing. And the third strategy is confluent levels strategy. In this strategy, we look for confluent levels of price action that give us the same signal. Confluent levels can have many different forms depending on the levels, zones, or patterns that are forming on the chart. For example, on this chart, you can see that the price here is in a trading range with the support level here at the bottom of the range. Starting from this point, you can clearly see that the price is forming a downtrend, so we can have this downtrend line based on these points. At this point, you can see that the this support level is broken and the price went for a pullback and retest of this broken support level that is now acting as a resistance level. On the other hand, we have this downtrend line which is also acting as a resistance level, and at this point we have crossing of these two resistance levels. This is a very significant zone because we have confluent resistance levels. One is this broken support level that is now acting as a resistance level, and the other this downtrend line. The probability of price declining after reaching to this point is very high, and you can see how the price declined after reaching to this confluent level. So when you find some confluent levels on the chart like our example here, those confluent levels are very potential areas that market participants will show reaction, so the price is very probable to decline or advance depending on the nature of the levels. In this video, I discussed 3 price action setups that help us predict potential movement of the market that have high probability. Please pay attention that no trading setup is 100% guaranteed, and there is always a risk of having the market against your prediction. So to protect your trading account, you must manage your risk properly with stop losses always in place according to your risk management strategy, so you can limit your losses in cases that the market goes against your position. Alright, that's it. Thank you for watching this video. If you have any questions, feel free to ask and leave a comment for me. I'll answer your questions as soon as possible. If you haven't subscribed to my channel, please subscribe and hit the bell so you get the notifications of my new videos. See you guys in next video, and good luck with your trading.